Hey, welcome back, traders. It's November 17th, Friday. I'm recording this at 10:20 a.m. Eastern Standard Time. The major market indices are currently up. Again, a reminder, this presentation is by Rain King LLC, and I'm an amateur individual growth stock investor. So lots to talk about this week. It's been a very powerful week. So we're going to look at the headlines, the indices, look at our trend monitor, and then we're going to look at the possibility that we're really seeing accumulation and what our watch lists are looking like. So let's start off with the headlines. Last week talked a little bit about how bull markets shake off bad news, and how the other thing that's important is bear markets stop going down on bad news, and that can be really, really bullish. And we said that there were some good tests coming up. So let's take a look. The bond market auction last Thursday was a weak auction, but yet we rallied. So that was a positive. Now, also, last Friday, we had U.S. debt was downgraded, and the market actually shook it off on Monday and continued higher. That was positive. The CPI report was the headline this week, came in better than expected, and we got a really broad-based rally, which we're going to look at closer. So again, that's another positive ignition point. Now, even on Thursday, we had Cisco and Palo Alto with earnings reports that really weren't that favorable. And even though some stocks, those two stocks gapped down, the rest of tech held up really good. I mean, Microsoft, Crowd, ServiceNow, NVIDIA, all acted really, really well and kind of shrugged off these bad reports from other tech companies. Another positive. And we've got some things coming still. We've got the government shutdown potentially looming. Maybe there's a deal. We have the war going on with headlines, and the PCE report, which is closely watched by the Fed, is also coming. But so far, we're really passing all the tests where anything the market is being thrown, we're ignoring it and we're going up, which speaks volumes. So the CPI, came out on Tuesday, and we got a broad, powerful rally. Is it suggesting that maybe interest rates have peaked? You can see here how everything is starting to come down. We're still not at the Fed's target of 2%. Now, this idea that higher rates for longer, which people keep repeating, maybe what the Fed is going to have to do is just say, look, the rates will remain high for longer, but we're not going to keep raising rates. This is a difference. Now, contrary to that, the market seems to be pricing in rate cuts in the second quarter of 2024. That remains to be seen. It might be a little aggressive, but the market is still acting really, really well. So I wanted to pull this up just to ground everybody. And this is a chart from 3Edge Asset Management. And it's showing the CPI year over year. And it's showing a couple of different market periods. It's showing in the gray the 1940s. The 1970s is shown in orange. And then where we are today, 2020s, is in blue. So I wanted to just track the 1970s. That was a high inflationary period, as you can see here. Eventually, with interest rate hikes, they started to bring down inflation. And they brought down inflation, but then they kind of took their foot off the accelerator, and inflation actually came back and reignited. And believe it or not, it actually went higher than what it was at the peak earlier. And then you can see finally it was brought down in a meaningful way starting the 1982 bull market. So got to be careful with what the Fed does here. You can see we're following a similar pattern of high inflation. We're bringing it down. We're not to the target. Let's hope this comes down and continues to be bent down and really stabilizes the inflationary pressures. You can see 1940 was a similar scenario. It peaked, came down, went sideways, but then spiked again even higher than the initial peak. So ground ourselves. I don't think we want the Fed to take off the interest rate and start cutting too quickly, because it could just spur inflation again. So they got to find the Goldilocks scenario. So let's get into the indices. This is the S&P 500 as of about 10 a.m. this morning. So very, very powerful rally. We had a distribution day last week, but we didn't think it was that much to be concerned after this sharp, sharp rally. And what we had was, again, positive action on Monday. This was Friday. Monday here is a small bar, which shook off the debt downgrade. We did not sell off. And you'll notice that on Monday, I put over here, the breadth was fairly neutral. And then we had this gap up on the favorable CPI report. Very powerful day, big volume coming in. And you'll notice that the breadth was actually very, very good. It was 10-1 advancers over decliners, much better than the S&P up 1.9%. Very positive. And then over the last couple of days, we're holding our gain so far with actually going sideways, a little bit of support yesterday. That's all very, very constructive. On Wednesday, we had a better breadth day than the market, and then yesterday was fairly neutral. So this is really, really powerful breadth starting to show up, really counteracting some of the question marks that were coming up last week with some bad up days. So the last 3 weeks has shown a positive, improving breadth situation. This is the S&P percent of stocks above their 50-day moving average. You can see here that we were really down at some lows, only like 10, 12%. We've spiked up really rapidly, improved. The stocks get above their 50-day moving average. We're up to 66 as of the close on Thursday. And that's, coincides with this breadth thrust we saw, the wide breadth thrust, and the big thrust we had on Tuesday's CPI report. So I've mentioned over the past month that we really, really were hanging in the balance on the financials ETF, the XLF, and the IWM. And we really identified a couple of weeks ago this exhaustion bottom in the IWM. Now we've had some gap ups, we had a sharp pullback, and we're moving higher. So the small caps are participating. There's rotation. Look at the volume spikes, very positive and constructed. And we were right down at these key support levels longer term. Now, the financials have also turned back up, and what they have done is gotten back above their 50-day moving average, which is what we want to see. So these are starting to really participate, and we need them to participate in a real bull leg higher. I've also called up here the XLK. This is the technology ETF. Gone all the way back to the start of the bear market. Here's the peak in November of 2021 in the bear market. Now you can see here, technology really has actually gotten all the way back up to new highs. We reached the new high in July. We had this correction, which was a 14-week correction of about 12%. But you'll notice that in only 3 weeks, we very powerful thrust higher, and we've moved into new high ground. So technology is leading the market again in new high ground. And the RS line was making new highs starting back in June, which is right here. So we're showing you that the XLK was really starting to outperform the market. And even in this correction where we came down, the RS line generally went sideways. And now the RS line is confirming this breakout to new highs. So this is a very, very positive chart. Another sector that we really want to participate, that usually participates in bull markets, is the broker-dealer ETF, XBD. And you can see a longer chart for almost 2 years here. And we can say, here's the peak in January. And you'll notice that the XBD has been making higher lows. And it tried to break out to highs back in July, got turned away, but made a higher low. Certainly looks like this is going to make an assault at a potential new high, which again would be another bullish piece of information for the markets. So let's go to our trend monitor, see where we are. Okay, the follow-through day is still working. We had a distribution day, but that was nothing to be too concerned about. And we've had actually a 12% gain in only 3 weeks in the NASDAQ. Very, very powerful. Now, breakouts and setups are becoming more prevalent. We're seeing setups more and more, and breakouts are starting to get traction. There has been an occasional earnings bomb here or there, but we're seeing much more traction, and we're going to talk about this more in a couple slides. Net new highs is still trying to get into gear. The New York Stock Exchange has had 3 net new high days in a row. That's a start. We want to see it on the NASDAQ, and we may be getting close. We are definitely still above the 20-day moving average. I believe by Monday, if we stay above there, we'll potentially have a power trend in place, and I'll explain the power trend next week if we get there. Breadth, we talked about Tuesday and Wednesday were extremely good days with breadth. which really counteracted those questionable bad up days we had last week. So this is real big improvement. And the volumes have been good. We got good volume on the up days. We've been up 13 to 15 days. So it's a powerful push higher, and the trend is really starting to get established, which is really constructive. So I want to move on to accumulation and watch lists. So this is what I showed last week, which was I still think it's important to look for fresh new merchandise, look for IPOs. They usually participate in bull markets. So I took last week's list, added a few names, and I highlighted in the blue the ones that I think are the most interesting with their charts right now. And in gray are the ones that are not performing well. So these are just some names that you should probably have on your radar screen, looking for entry points. If we are really in a bull leg, some of these names are going to be outperformers, and some are already moving out. Dash, DraftKings, Duolingo, these stocks are already moving. And I believe as I speak, Shark Ninja is breaking out of a cup with handle. So we're really trying to understand, are the institutions building up new positions? Are they accumulating? I did a GMU Extra way back in April 24th, and I really encourage you to go to watch this 8-minute video, which describes how institutions accumulate their positions and eventually distribute their positions and sell. For 8 minutes, this is one of the better videos, I think, describing how institutions do this. So I encourage you to go back and look at that GMU Extra, because I think it's relevant. Now, back in 2022, breakouts were not working. You know, I've just called up a few. Here's roadblocks. We were not getting traction. We break out for a day and stall. We get stopped out. End phase. Break out of a double bottom for a couple days and immediately rejected. Here's ANET, even as early as February of 2023, only up for a day, stalls, stop out. So we were all been kind of conditioned that for the last 2 years, breakouts are not working and you should not buy breakouts. But we have to be open to things changing. So when we have all these breakouts and we're getting conditioned to not buy breakouts, I've circled this crowd psychology component. When you get a new follow-through day, you know, and things start to break out, the retail investor tends to be very, very hesitant here because they've been conditioned by all of these false breakouts in 2022 and throughout maybe some of 2023. And so when you get the follow-through day, they're not in a good frame of mind, and they actually won't buy until they get very, very timid, making small buys. And when you get a correction or a pullback, they get very scared because they say, it's not going to work, I'm getting out. And what happens is they end up, if they do get a small gain, they will take that gain very, very quickly, probably at the worst time because we're looking at a bull leg that's starting. This is all crowd psychology. And it's because you get conditioned with false breakouts. So we have to be open, though, that things could be changing. So I'm just looking at the post-breakout action in this rally attempt. So here's a breakout of a double bottom for Uber. You can see we broke out, and look at the follow-through buying. We're getting good volume, and we're up multiple days in a row. That's different than we saw in 2022. Here's a net. Just broke out, even a little pullback, came back to the 10 EMA, and it got support, which we didn't see in 2022, and it's moving higher. Another breakout was DraftKings, a very powerful breakout, came back to the pivot, probably scared a lot of people, and now it's moving higher again. This is change. We're seeing the action of breakouts change, which means institutions are probably accumulating stock in those bases. Here's crowd. We've talked about this ascending base. It breaks out. We get follow-through buying, and it was really impressive yesterday the way crowd held up and got support, especially with Palo Alto gapping down. So the action is changing, and we need to be open to a rally. So the initial follow-through day is working. It's been strong, and we're off to a really good start. We've had some big breath days, and the new highs are trying to get into gear. Now, these healthier and longer bases that were formed, good 12-week bases between August and the October correction, good launching pads for stocks. And there's a lot of stocks that are within 52-week highs. So institutions are the ones that built those bases. And don't forget, institutions, when they build a position, they're holding it for 1, 3, maybe 5 years. So if they are accumulating stock, they're not going to sell the first pullback. If they spent 3, 4, 5 months building a good sized position, they're not going to sell it for a 10% gain. They're looking at actually doubling or tripling their money. So it seems like we've got a good launching pad. We are seeing signs of accumulation and change. So that's very constructive. Now, we are at a sharp run up. It's possible that we need to have a small pullback or we need to just consolidate gains. So we always learn more about the first pullback in a rally attempt. We want to see a pullback that gets support and then we push higher. Now, if you remember the July pullback, we were monitoring it closely and we morphed and it started to pull back and all of a sudden it started to really break down, and it actually turned out to be a 12% correction. So monitoring these things in real time is key. Then we had that October follow-through day in early October, and we had distribution very soon after the follow-through day telling us that the market timing was just not right and that things were just not set up. Now, so the question is, does this rally really have the legs? We're trying to see a trend get in place for months or longer. So we are kind of expecting some sort of pullback or just consolidation of gains. And again, I remind people, if you're a swing trader and you've been really just catching these swings, you've probably done pretty well throughout the bear market and the challenging environment. We've all been conditioned to take the quick gain. But what happens sometimes is if you're a swing trader likely taking quick profits, you're kind of waiting for a pullback to get back in, and you might not get a substantial pullback in a very powerful rally, and you won't be positioned properly. Myself, I'm a position trader. When you start taking new positions and managing your risk, we can use the pullback to add to positions to build more size if we start to see a real trend to develop, and that's when we can make bigger money. Of course, all of this is with managing your risk. So position trading versus swing trading, it's pretty important to know where you stand if you are a swing trader or you're trying to play out a big position trade. So to wrap up, the wrap up is quick. The follow-through day is working. It's been very powerful. I've mentioned it a few times. The trend change, we got positive evidence this week. The remaining piece is to get net new highs, but that quickly could kick in because so many stocks are in bases that are just below 52-week new highs. So that could change very quickly. We are in a seasonally strong period. We mentioned that the watch list names, leaders are starting to move and become clear who they are. So exposure levels, I believe, need to be moved up somewhere in the range of 30 to 50%. We're getting good market feedback here, ignited by that CPI report. Personally, I'm 40% invested, but I'm actually just making some purchases today, so I'll probably be up to about 50%. But everybody's different. Some people are probably way more aggressive than 50%. Others are maybe underinvested below 30%. So do what's right for you and your risk tolerance. Again, the pullback or a pause would be very normal right here. We've got to watch it carefully. We're going to watch the leading stocks. How much do they give back? And we're going to monitor if we get any distribution in the indexes. But it's a good picture right now. Things are green. So let's take advantage of it while it lasts. And the quote of the week is from William O'Neill. It's really a passage of the week. And it's, don't worry. You don't want to worry about what you did 2 weeks ago or 2 months ago. You were just assessing the market that time and place. And remember, 2-3 weeks ago, we were very concerned about the market. So it doesn't matter. What matters is what the market is doing now. The next part of the passage is the market doesn't let you do just everything that you want to do. It does what it wants to do, and you have to find and follow it and act and not get hung up on, quote, gee, I sold this 3 weeks ago and 3 months ago, and now it's 4-point higher. What does that have to do with what's going on in the market? It's just your emotional feelings. In the markets, we use rules, we use statistical basis, we don't use our feelings, which can get us into a lot of trouble. They can have us scared when we should be buying, and they can have us too extended with our buying when we're making good money and we get greedy. So great passage from William O'Neill. We're evaluating the market in real time, and right now it's telling us it's a good time to get invested if you're a growth stock investor. So that's the general market update for November 17th, 2023. Here's where you can find me, and I look forward to seeing you on the next one on next Friday.